This is TreppWire Week in Review for the week ending August 2nd, 2024. I'm Haley Keene with Trepp, a data modeling and analytics firm for the CMBS, commercial real estate, and CLO markets. I'm with Lonnie Hendry, Chief Product Officer, and Stephen Bushbaum, Research Director. This week, the Fed unanimously voted to hold rates steady for the eighth straight meeting. However, for the first time in years, Chairman Powell cited risks to the employment market alongside continued concern about inflation. The Conference Board's Consumer Confidence Index increased above economists' expectations in July, but remains within the same range it has been for the last 2 years. Consumers are reporting growing fears about jobs and prices. Job openings fell again in June, and the ADP reports that the 122,000 new jobs added in July is the smallest gain in 6 months. Additionally, the quits rate fell to a nearly 4-year low as the labor market continues to cool. And despite the Case-Shiller Home Price Index hitting a new all-time high in May, pending home sales rose in June in line with a rise in listings. Stephen, we've said that a 25 basis point reduction in interest rates won't suddenly make thousands of deals feasible, but what does that likely win for the rate hawks in September mean for CRE performance? And what will you guys be paying attention to going forward?
Well, 25 basis points won't do much, but it has been interesting to hear how many people are muttering about the possibility of a 50 basis point move, which, based on Chair Powell's comments at the press conference, I don't want to say that's a strong possibility, but let's step back from this for a moment and look at what's happened. Almost 8 months ago, the market rallied massively, expecting the Fed to cut rates in the near term. Fast forward 8 months, and now we're finally 1 month closer to it. It's a bit comical in some ways. One thing that stood out to me that is worth mentioning, this was a fantastic comment that I heard yesterday morning that we've kind of danced around, but this is a much more elegant way to say it. And that is, if a 5.3% Fed funds rate, and that's the midpoint of the lower and upper bounds. But if that's the right rate for last year, when inflation was double where we were at right now, and employment certainly was a lot stronger back then, it'll be interesting to see how the Fed navigates this going forward, because how can we say that 5.3% is still the right rate when the data is much, much weaker in the current context? Now, that being said, last week's GDP print, that definitely played to the Fed's hawkishness, but we're in a very interesting spot here with the data because it does feel like there is tangible weakness wherever we look outside of that GDP print, which is very backward looking. Lonnie, what do you think here?
If you listen to what Powell said for the last, 18 months or so, it's been inflation and the labor stuff. They've seen, inflation come down, not quite to where they want, but close. But up until recently, they hadn't seen the movement that they want in the labor market to justify, maybe switching and cutting rates. I think that they're realizing now that a labor market shift has started to take place. And I think this is where it gets really precarious. The inflation number doesn't move as fast generally as the labor number can. So that consumer confidence, or people thinking they're going to lose their job, has systemic risk across the market very broadly, very quickly. So if people stop spending money because they feel like they're at risk of being laid off or let go from their employer, you're going to see a significantly faster impact to the markets broadly. And so I think Powell's trying, like, the safe landing narrative that we've talked about. This is where it gets really precarious, where, you see those videos where in high winds, they have to land the plane effectively sideways. I think that's kind of where we're at here. On the flip side, he doesn't want to come out and say, oh, we're going to see a 25 basis point reduction or maybe a 50 basis point reduction, because guess what? GDP that came out was insanely high and inflation's still not at the target, right? So it's like we're just getting really close to where they want to be. And I'm hopeful that we won't see so much labor movement that this causes, some widespread psychological stigma across just the consumer base. And we actually get where we need to go, because it feels like we're really close. And I feel like Powell, if this goes to his plan, is probably going to be able to do a 25 basis point reduction in September. Even though the math doesn't change, we've talked about this ad nauseum on the podcast, the sentiment around it will change. I think it'll be a broad brush signal to the market that the inflation fight is over, and we're going to return to some form of normalcy. Obviously not the zero rate environment that we were in prior, but we're going to have some sort of normalcy. And I think that'll by itself stimulate some activity in the marketplace. And so given where we're at today, Stephen, this is the kind of movement we needed to see the Fed actually pivot. The challenge is just the stakes are higher now because the other component, that labor component, I think is much more volatile and has some challenges to kind of keep that in check within a range that allows for the reductions in the rates. Be interesting to see. I think for CRE perspective, listen, the refinances are the ones that are at risk. We've seen some transaction velocity start to pick up, even in the higher rate environment. So I think people have realized their underwriting can be underwritten at the current rates. The likelihood of rates coming down over some 5 to 7 year period is probably favorable. So people have started doing deals again, clearly not at the levels they were in 20 and 21, but we've seen an uptick in activity. On the refinance side, though, that's where they really need some help. And I don't know the 25 basis points helps significantly on that front.
Yes, it's really a tale of two Americas in some ways. There was a report put out by the Labor Department that highlighted that middle and lower income Americans have generally faced faster inflation than affluent households from 2006 to 2023, thanks in large part to housing and insurance prices, which we've talked about numerous times in the podcast. That fight to battle inflation has been critically important to try and help stop this budget bleeding that's really hammered on middle and lower income households. And we've seen that weakness or the concern show up in earnings reports. We just look across a few different restaurants here: Starbucks, McDonald's, and Chipotle. Chipotle, out of the three, was the only one that really came in strong. And you think about who they cater to versus, say, McDonald's. It's really, really interesting. Even though we've talked about some of the higher income households cutting back on, say, regular restaurants and going to fast casual. So Chipotle restaurant traffic increased 8.7% for the second quarter on a year-over-year basis, contributing to an 11.1% rise in same-store sales, surpassing the estimated 9.2% growth. That's in stark contrast to McDonald's, which saw same-store sales decline by 1%, marking the first decline since the fourth quarter of 2020. And then let's turn to Starbucks. They also had a revenue miss as same-store sales decline for a second straight quarter. So those same-store sales declined with a 14% drop in China and a 2% drop in the US, where traffic fell by 6%. And so I think you're starting to see evidence of real pullback in consumer spending. So we talked, I guess, over the last 2 weeks about the second half of the year could get very, very interesting, especially when we get into November. And I think that's starting to percolate up in the earnings data and the forward guidance that we're hearing.
Yeah, and there's a whole other side of the equation here, Stephen, which is the home sales component. So, you know, the residential market is really teetering on the brink of, I think, something pretty significant. You have all these changes that are underpinning the market with the National Association of Realtor lawsuit and settlement, and how that commission structure and all of those transaction activities are going to be changing significantly. That rolls out August 17th. You have had a surge in new listings hit the market. And so it's really this dynamic of there was a perception of significant home equity across the marketplace. And what you're seeing now in some markets, people having their homes listed for 3, 4, 5 months with no offers. And so if they lose their job, if just cutting back on spending isn't enough to make the monthly budget work, and they can't sell their house and, you know, access any of the perceived equity that they have, I think it could be pretty significant. So there's been a lot of numbers published over the last couple of weeks on the residential market. And that's not really something we focus on here, but there is a pretty strong conviction growing that the residential market that we've been experiencing for the last several months, which even with high interest rates, you would have assumed it's slowing down, that decrease in supply initially led to still increasing home prices. It's really hit an inflection point. You're starting to see the data come back the other direction. Too many houses available for sale. Too much uncertainty around how they're going to transact with the new settlement with the Realtor Association, and then just a lack of consumer confidence in spending. So it's really interesting. We did contribute to an article this week in the Wall Street Journal with our friend Peter Grant, which, you know, he was alluding to a bottom being very close in the CRE market due to recent rise in foreclosures, you know, effectively suggesting that the stress had worked its way through the system and markets may be more bullish going forward. You know, I don't know about this, Stephen. I think from my perspective, I think in the CRE market it's probably still too soon to call the bottom. I think that there's definitely going to be some positive stories coming out of where we're at. There's clearly been a number of really low bargain basement type foreclosure sales, which make headlines and everyone thinks, wow, this has got to be the bottom. I think widespread, though, there's still a lot more distress that has to make its way through the system. As we've highlighted on the podcast and put some research out, the number of modifications and foreclosures over the last couple of years has been significant. And that distress, whatever you want to call it, has not played its way through the system. And so I would suggest if you look back at the GFC, we didn't hit the peak delinquency rate coming out of the great financial crisis until July of 2012. That started in 2008. This downturn effectively second half of 22. We're just now in the second half of 24. I still think it's way too early to call bottom, although I do think in some markets for some property types, you may get to a bottom in terms of price floor for particular assets in particular markets. But broadly, way too soon, in my opinion, to call the bottom. What are your thoughts?
I agree. But to be fair, I could make a case for this being a false bottom, to your point, and we take another leg down, or if the Fed does move aggressively and we're able to stave off some of that really dramatic downside risk that I think is built up. And specifically, I want to turn back to one other data point that we have here. It's a UBS analysis on federal data that showed accumulated savings from the pandemic have been fully depleted for the bottom 40% of earners. So to your point earlier about, if somebody loses their job, they have their house listed, this could go south. Whereas 1 or 2 years ago, you might have had the ability to carry that mortgage for 1 or 2 months. The job market was healthy. You could get back on your feet fairly quickly. But if your savings has been drawn down and it's taking longer to find a job, this could get ugly very, very quickly. Wonder if the Fed is contemplating some of this themselves, thinking that the risks have become more balanced, but they are looking more skewed to the downside from the labor's perspective, given the weakness that we're seeing in the jobs data. But to be fair, tomorrow will be, I think, the really important data point to watch when we get non-farm payrolls. Back to the point about how this distress will play out. If we think about what's coming due in mortgage maturities, the 5-year loans are the ones that concern me the most, because the 10-year loans have benefited from a long run of accumulated appreciation, which might get drawn down or depreciated once we have gone through this, first, let's call it the false bottom or potential false bottom. Whereas those 5-year loans had a lot less appreciation, that's completely evaporated. And, to the point about the rise in foreclosures, this could continue to get uglier, to your point. And, well, there's always knock-on effects for distressed sales.
Yeah, I think to me, when you have a market where the market is foreclosure or the market is distressed sale, so if you had 10 sales and 6 or more were foreclosure or distress, to me, that's indicative of us hitting the bottom. If you just have 1 or 2 out of 10 that are foreclosure or distress, I think it's a fair representation that there's distress in the market, but I don't think it's a representation that we're at the bottom. And I would suggest that's where we're at. It'll be interesting to see, kind of like the labor discussion I had earlier, like the real estate market moves very quickly, both going up and going down. So when values are going up, sometimes your appraisal is outdated by the time the lender actually gets it because there's been 2 or 3 other properties that have sold at a higher price. And the same thing happens on the downturn. I just don't think we've hit that critical mass yet where we're seeing that, what we call the doom loop or the cycle or race to the bottom. And I don't know that we're necessarily going to see that. I know, Stephen, you did some analysis on the top 100 banks, and we talked about that last week a little bit. I think the banks are realizing that on their, the office portfolios, if they're concentrated at less than 20% of their overall portfolio, why wouldn't they just strategically divest of those assets in a kind of a guaranteed loss manner where there's we're going to take a 12 or 15% haircut on these 10% of our loans. We can accrue for them. We know what the damage is going to be. That stops this hysteria around it. Why don't we just start doing that in a strategic manner versus letting the market dictate what happens when borrowers start walking away and you're forced to sell without any control? I think you're going to see some of those lenders be proactive at this point, realizing that it's not the end of CRE lending for them. It's 1/5 of their portfolio or less, and not all of those loans are bad loans. Maybe it's 30 or 40% of those office loans that are really not working for them. So I don't know what your thoughts are on that.
I completely agree. And if you look at some of the quarter-over-quarter changes, or maybe even just longer-term 1-year changes in the office exposure, you are seeing some pretty dramatic drops in the office exposure. So Deutsche, that did have the largest exposure of any bank I had looked at, they had a massive reduction in their portfolio for office exposure from, it was like a 60% handle down to a 40% handle, which is still very, very heavy-handed in office. But, it wasn't just Deutsche. It was a number of other banks that either through natural roll-off in the portfolio through loan sales, write-downs, what have you, a combination of strategies. They are being, I think, very proactive where they have the ability to. So my curiosity, without seeing the individual loan level data and the performance metrics, is I wonder, will they price at that 10 to 15% discount, or are you seeing deeper discounts demanded at this point in time, especially if we're rolling up on some concern about a little bit more than a soft landing, but something a little bit more painful?
Yeah, and that's where we're going to see over the next, I call it 90 or 180 days, where if we sit down and have this discussion again around, are we at the bottom, we'll have a lot more data to support where we're at, just because I think we're going to see a lot of activity with the lenders, and some are going to take a more strategic approach and some maybe a little more wholesale approach. We know the dry powder's on the sidelines. We know people are itching to make deals. To your point, where's that price got to be for them to move that money? I think we're getting a lot closer to that price discovery than we've been in the last several months. So exciting times. I mean, listen, it's 2024, August 1st. It's amazing if you just go back over the last 15 or 18 months and just look at the ups and downs, the ebbs and flows of the market sentiment. At one point, we were pricing in 8 or 9 rate cuts. Now we're not sure if we're going to get just one. Now there's maybe contemplation of a 50 basis point rate cut. I mean, if you're not interested or get jazzed by this stuff, you're probably just not a data nerd like me and Steven. But it's been a really cool ride for the last couple of quarters to kind of just see the sentiment shift back and forth. And I think we're getting really close to just seeing where things fall out.
Yes, it's been quite humbling for anybody that wants to make a call in this market.
Yeah, so we actually talked about this in a few of our newsletters this week, and we tied it back to our delinquency data because we've been tracking that for a long time. So we noted that, of course, not all economic downturns are the same. And we looked back to the global financial crisis and noted that CMBS delinquency rate didn't actually hit its peak until July 2012, when it hit 10.02%. So that was 4 years and 7 months after the start of the crisis in December 2007. And likewise, we saw the same thing with the special servicing rate, which is another metric we use to look at loans that are problematic, but they aren't necessarily delinquent yet. And that peaked in May 2012. So I think it's interesting to look back at the past crises, and then this ties in well because we now have our July delinquency data that we revealed this week.
If you go back even further to the dot-com bomb or the dot-com bust, which took place, starting around March of 2001, just to give you some context, CMBS delinquency rate at that point was 0.85%, which was, nearly inconsequential. It peaked at 1.78% in October of 2003. So even that disruption, which on a relative basis was fairly insignificant, you're talking a 2-year type of time frame to hit peak delinquency. Special servicing for that disruption peaked in March of 2003 at 2.82%. And then COVID, I think, which was what spurred this downturn, you had so much new liquidity being injected into the economy by the federal government. And as Stephen mentioned, people are just now depleting those funds. I just think we're on the early side of the curve. So Stephen, I know you and your team put together some delinquency data for this month. I don't know if we have a drum roll sounder yet, but let's go ahead and rattle off the July delinquency data.
So the headline number only rose 8 basis points this month to 5.43%. Seemingly, the headline number really wasn't all that bad, all things considered. But if we dig beneath the surface, that was almost exclusively driven by the office sector. About 1.88 billion in office loans became newly delinquent in July, which was offset by just shy of 600 million in office loans that were previously 30 plus days delinquent in June, but were no longer delinquent in July. So the office delinquency rate has now breached the 8% threshold, which is the highest since November 2013. The two property sectors that saw a decline in the delinquency rate were retail and lodging. Now, if we look at the largest loans, because this is where you really need to dig into the loan level data to understand, well, is this a broad systematic risk, or is this some high dollar loans that it's the typical concentration risk that you face with a dollar weighted indices like this? If you look at the largest office loan that became delinquent in July, it contributed to about 1/3 of the amount of newly delinquent office loans. And this is a loan that has bounced back and forth between non-performing matured balloon and performing matured balloon. So this month, the status flipped back to delinquent. So if we included loans that were beyond their maturity date, but still current on interest. So these are the non-performing matured balloons. The loan has hit its balloon maturity date, but the borrower is continuing to make their regularly scheduled mortgage payment. So if we include those in the delinquency rate, even though the borrowers are still paying, that rate would be 6.78%, up 24 basis points from June. So that's a pretty big delta between the pure delinquency rate and the adjusted delinquency rate that includes performing matured loans. And that highlights just how difficult the refinancing market is in the current environment. So if we step back from this, we're going to use, let's call it Bushbaum's stupid, simple, what kind of a recession could we see here for commercial real estate? Like, where are we going to peak out? If I think about prior cycles, to me, this feels like somewhere in between the more benign .com bust and the '08 financial crisis. So if we split the difference there, it's kind of where we're at now. So yeah, we could take a leg further up, but what we'll really be keeping our eye on is how those shorter term loans perform, because what's really going to be critical to track as we see this cycle play out is remember that in 2018, 19, going into 2020, one way to lower your borrowing costs as the Fed was raising rates was to shorten up duration. And if we learned any lessons from the '08 financial crisis, which I think we learned plenty, it's that the 5-year loans were particularly damaged, as I mentioned earlier. And so given that shortening up of the duration heading into the COVID crisis, we got some relief from the Fed, but those loans haven't exited the system. So to your point, we could be in for another leg up in delinquency here over the next 18 months, depending on how these loans perform, how the broader economy performs.
Yeah, I think at some level, some of these office owners and others have been fighting for their properties because the broader market has been, giving them signs that there's maybe hope that people will come back to the office. And I was bullish that if the economy started to falter, people would be running back to the office to save their jobs. I don't think that narrative actually plays out given where we're at today. I think people have accepted the fact that they've made life adjustments and they don't want to be in the office, and they're probably not going to go back to the office, even if that means being laid off. So I agree with you. I think we're going to see some increased delinquency. When we have such a small increase month over month, though, Stephen, I thought you might refer to it as bips, just to try to make it sound a little bit more significant. But 8 basis points is not anything that earth-shattering for this month. But the office number over 8% gets pretty dicey, and I think it gets us closer and closer to that double digit, where I think at that point, the narrative changes for the worse for office, if that's possible. At this point, it's been most widely discussed property sector that we've had in the market. But at 10% plus delinquency, I think things change for the worse for them.
Well, speaking of some fun terminology, Lonnie, you'll know things are serious if you hear me break out the term stick. And to use it in a sentence, if the delinquency rate moves up a stick, things have gotten really, really bad. A stick refers to 100 basis points or a 1% move because it looks like a stick. So, fortunately, this month we were in basis points and not a stick.
All right, so let's jump to another topic that we've been talking about, but we covered it again this week, so it's top of mind. We've been looking into insurance costs, and specifically this week, we looked at how they are causing headaches for apartment values.
Yes, so this is some fantastic research from CBRE, and they did a deep dive on insurance expenses and the valuation impact. So they noted that insurance premiums are the 6th largest expense for properties, and while they comprise 8% of total expenses, they contributed to 17% of expense growth since 2019. Now, taxes are typically the largest category of expenses, totaling more than 25% of the total expense bill. Now, if we think about the basics of how the income statement works and cap rates and values, obviously, if you're not able to get a full reimbursement on 100% of that marginal increase in your taxes, that's going to degrade your bottom line. So if your bottom line cash flow drops and we hold cap rate constant, that decline in NOI is going to mean a drop in value. If we look at how much premiums have grown, they grew by an average of 10.1% in the first quarter, according to the Council of Insurance Agents and Brokers. That compares with an 11.8% increase in last year's fourth quarter, and in the first quarter of 2023, they climbed by 20.4%. So there's some very clear-cut disinflation pattern, but if we think 10.1% is a comfortable increase based on how all of our incomes adjust on a regular basis, granted we're talking a little bit apples and oranges here, that 10.1% is still very difficult to digest.
We've been talking about this. We jumped on the insurance story a long time ago. I mean, over a year ago at this point, to put together a narrative around how impactful this will be. And I think it's finally hit mainstream where people are having to pay attention to it. I'm recording this podcast, Haley and Steven, you guys know this. I'm in DC this week. We got invited out to speak with Senator Gary Peters from Michigan. He saw our clip on CNBC and his team reached out and asked us to come and give some CRE insight and just a little bit of knowledge share based on our data in person. So I've been out in DC. I got to meet with the senator yesterday. And obviously he was interested in the national narrative and very interested in the Michigan narrative. And so we had pulled some data together. So this ties in nicely with the insurance study from CBRE. If I were to tell you, Stephen, insurance expenses for the state of Michigan on a per unit basis, do you think they're up 50%, 70%, 100%, 10%? What's your guess for the state of Michigan since 2017?
If you told me triple digits, I wouldn't be surprised, but I'm gonna hope for high double digits.
76.4% since 2017. So insurance expense per unit in Michigan is up 76.4% since 2017. Utility expenses for multifamily up 26.1%. Total operating expenses up 26.3%. And this is compared to net cash flow growth of 17.9% over the same time period.
So if we drop back in the CBRE research here and look at the valuation impact, the area that's been the hardest hit by the insurance increase has been the South Central region, which includes Louisiana and Texas. And we know they've just been absolutely brutalized by floods, hurricanes, tornadoes, just regular convection storms, thunderstorms. Values there have declined 7.8% since 2019, solely because of higher insurance costs. Florida came next with a 6.8% decline. I mean, these are just staggering numbers for what used to be a snoozer of a line item for underwriters and appraisers.
Yeah, it was kind of just a necessary evil. People just looked past it. You did what you had to do. You got to sign off and you moved on. Now it's a real problem. And to your point, it's impacting value. But we say all of this in spite of the insurance increases, in spite of the uncertainty around expenses broadly, in spite of the fact that rents have, abated or declined in some markets. We just got some transparency in the large $2+ billion transaction with KKR in the multifamily space. That deal closed at, a very low 4% cap rate. So, sometimes math doesn't necessarily have to make sense. There are other motivations that move people in certain directions to place capital. I think for your smaller owner operator types, less institutional folks, the insurance narrative is very real for them because it can be the difference between a deal working and not working. But it feels like for some of these larger players, they view it as something that's maybe short-term in nature or something that they can manage around.
Yeah, and I look at it and I don't know. The Wall Street Journal had a very, very good piece out today talking about umbrella insurance and how there's been a 24% increase in claims for those $1 million plus umbrella policies. 24% increase in just, I think it was the last year, very short period of time, really is the point here. And so the insurance industry has a lot of disruption going on. And the general sense I get is that there's not an immediate end in sight. It might be slowing down in terms of the premium increases, but we are not yet done from this repricing.
I agree.
So let's turn to our property type segment. We had a lot of stories this week in our newsletters and that we tracked with new Trepp data. So we can start by looking at some office loans that were sent to special servicing.
We saw a $29.2 million North Point Business Park loan transferred to the special servicer due to payment default. The loan was scheduled to mature in July, and the servicer data now reflects a non-performing matured balloon delinquency status. This is a 250,000 square foot office property located in American Fork, Utah. It was built in 2008. The asset was appraised at $50.4 million at securitization in 2014. In 2023, the loan posted a DSCR based on net cash flow of 1.24 times with occupancy at 76%. The DSCR dropped from 1.47 times in 2022 when occupancy was at 100%, and it had stayed at 100% for the past few years. The second largest tenant at the property, Fidelity Real Estate Company, occupies 20.7% of the space and had a lease that expired at the end of April. The largest tenant of the property, which had 29.06% of the space, has a lease that doesn't expire until 2030. Now, jumping over to Illinois, we have a $37.6 million Highland Landmark 1 loan that was transferred to the special servicer at the end of June for payment default. Now, this loan doesn't mature until August of 2025, so this would be an early transfer in the scheme of things. Usually, we're seeing anticipated maturity default transfers anywhere between 3 and 6 months, at most 8 months in advance. And so this one being a year out is a little bit early. So this loan now shows 60 days delinquent as of July remittance data. The property is a 293,000 square foot medical office building in Downers Grove, Illinois. The asset was built in 1997, and the collateral was last appraised at $64.6 million at securitization in 2015. In the first quarter of 2024, the loan posted a DSCR based on net cash flow of 1.87 times, with occupancy at 86%. However, the top tenant, Advocate Healthcare, which occupied about 73% of the property, exercised its lease termination option that was effective April 2024. The loan prospectus states that AHC has a $9.2 million termination fee. Servicing commentary indicates that the collateral is being monitored for cash trap activation, and whether or not the vacated space will be filled by a new tenant is crucial for occupancy and cash flow concerns on this loan. So this is a very, very big deal. Fortunately, having a $9.2 million termination fee does blunt some of the damage on this.
So, Stephen, on that particular story, why don't you give us a quick description of cash trap activation? Obviously, if you're not in the CMBS market or you don't work with these deals, you may not understand what that means. Can you give us just a quick rundown?
So you're not talking about the cash trap that my kids do with my wallet, right? No, in CMBS, a cash trap activation, typically there'll be a trigger event. And so it could be something like, say, the debt service coverage dropped below a given threshold. Say it dropped below 1.25 times. It could also be driven by, say, a tenant event, a notification that they're going to vacate the property. In essence, what happens here is that the lender doesn't want that excess cash flow to just bleed out of the property. They don't want to see that cash just go away and not serve to help protect their interest in this loan. So by trapping that cash, they can ensure that bills continue to get paid, anything that needs to be reserved for, such as upcoming tenant improvements, leasing commissions, repairs and maintenance, what have you. All of that will get funded to the extent possible. And in some cases, the cash trap can even be used to pay down the loan in part.
And we'll turn to retail. Of course, we saw some more large appraisal reductions this week.
Yeah, so it looks like in the retail sector, kind of piggybacking off of what Stephen just walked through in the last segment, we have some appraisal reductions across the spectrum. So this particular story, property backing a $30 million loan at 136 through 138 West 34th Street, has received a large appraisal reduction. Loan transferred to special servicing in January when it defaulted on the balloon payment at maturity. The delinquency status has been listed as non-performing matured balloon since then. Watch list notes from late 2023 state that the borrower requested the loan to be transferred to special servicing for loan modification discussions. This property is backed by a 25,000 square foot retail parcel near Macy's in Midtown Manhattan. The property is made up of two adjacent buildings, were built in 1902 and renovated in 1987. Property was appraised at $61 million at securitization back in 2013. Most recently, the asset's been revalued at $20.9 million, about a $40 million reduction, which is just over a third of the amount of outstanding debt left on the property. Two tenants make up the entirety of the space, each occupying 50% of the property. Simple Capital Partners, which is doing business as New York City Gifts and Luggage, is one of the two tenants, and servicer data shows the SCP lease as expiring at the end of 2023. The second tenant, Sterling Jewelers or K Jewelers, has a lease ending the end of 2024. Last November, Simple Capital Partners wrote that they would be vacating. However, watch list notes from that time indicated that the lease ends in late 2024, even though servicer data still showed late 2023 lease expiration. So this is one of those where there's something that doesn't match in terms of, the lease expiration date, but them still being in the facility. Unfortunately, the property has not performed. If you look at debt service coverage at net cash flow as of September of 23, it was at 1.12x.
And we have one more story here to wrap up our individual property segments, and this is over in lodging. We have the appraised value on a property backing the $42.5 million BWI Airport Marriott loan has been cut to below the outstanding debt amount on the property. The loan collateral is a 315-key Marriott full-service hotel next to the BWI Airport in Maryland. The asset was built in 1988 and renovated in 2017. Property was appraised at $68.2 million at securitization in 2017. The value has fluctuated multiple times over the years, but the property was most recently reappraised at $37.2 million. The most recent prior appraisal to that was in 2023 for $43.5 million. The loan transferred to special servicing in November 2020 for imminent monetary default as a result of COVID-19. A foreclosure sale occurred in April 2023, and the lender was the winning bidder. The asset became REO in August 2023. Servicer notes indicate that the special servicer was planning to sell this asset, but elected not to sell due to limited offers received, and they will revisit a potential sale later. In the first half of 2023, the loan posted a DSCR based on net cash flow of 1.25 times, with occupancy at 78%. And this loan was originally scheduled to mature in December of 2027.
And for a programming note, we have been busy all summer, but we're about to get even busier with conference season coming up in the fall here. The TreppWire Podcast team and Trepp as a whole will be attending a lot of different conferences, and there's opportunities to meet with us and record with us and get your experts or you on the show. So one we wanted to talk about today is one that our friend Ken Ashley is hosting in September in Atlanta, and that is the CREI Summit, the Commercial Real Estate Influencer Summit. This is a great show where people who have a large presence in commercial real estate, but also see the value in social media and community, are coming together to network, to learn from each other, to sit in on insightful panels, and to do deals. So we're really excited to be attending that one, and we look forward to being there.
Yeah, we've enjoyed working with Ken and his team. It's a really great mission, effectively bringing together some of the industry influencers that leverage social media and other best practices. It's predominantly broker focused or transaction focused as people that are actually doing deals in the market. We feel really fortunate to be involved with them as a data provider. Obviously, we think our data helps production folks make more money and do more deals. So it's a really great synergistic relationship. But our podcast team is going to be there at the conference. If you'd love to get some time with us, if you have your own podcast, if you just want to catch up with us, or if there's ways we can help you, or you want to record some of your strategies or some of your business thoughts around CRE with us, we're happy to do that. So if you haven't registered yet, you should go to the CREI website. We've been promoting it on the last couple of podcasts here at Trepp and pushing it out in some of our rundown newsletters and other mediums as well. But you can just Google CREI, find the website, and get registered. It's going to be a really great time, and we're looking forward to it. And as you mentioned, Haley, we have a lot of conferences coming up. I mean, like if you look out on the calendar for the next couple of months, it is crazy the amount of travel that we're going to be doing. But we love it. And if you want to book us, if you want us to do a podcast at your conference or your event, you should reach out to us because we'd love to get to know you guys. We'd love to meet with your teams, with other people that maybe are attending a conference or an event you're hosting for your internal organization. So reach out to us at podcast@trepp.com, and we'd love to get something on the calendar with our listeners as well.
Yeah, and on that topic, Lonnie, a few days ago, our friend Tom W. at KeyBank, who works very closely with the California MBA conference, sent me a note on LinkedIn and reminded us that we have the Western States CREF conference coming up. So we will be doing a live show at the MBA California event there with our friend Chad Carpenter. So that's another one that we have coming up that we're really looking forward to attending and speaking at.
Yeah, so I've had a lot of interaction with folks that are going to be at the Western States MBA conference. It's actually going to be hosted at ARIA in Las Vegas. It's going to be a great event. As I mentioned, several people have reached out on LinkedIn. We definitely will be there. We're going to be doing a live session. Love to meet up with as many people as we can at the event. So if you have interest in talking with us, if you want a podcast t-shirt, if there's something that we can do to help you, reach out to us in advance. We'll find some time on the calendar to make sure we get synced up. And definitely join us at the event during that lunch session so you can see us do our podcast and panel discussion live at the event.
And turning to shout outs, we had a lot of great data on last week's episode. I may be biased, but we did some in-depth analysis of CMBS losses and bank earnings and exposure. So a lot of people came out from hiding and told us that they're interested in the data and reached out to us. So thank you for that. We love hearing from you guys. So feel free to reach out if you're interested in digging into anything further that we talk about, or if you just have a suggestion or a comment for us. So Dan W., he very much enjoyed the latest episode and was interested in the data we referenced last week. He looks forward to listening to each of our episodes and let us know that he leads the CRE debt strategy for a $23 billion AUM multi-strat fund. Michael M. was listening to last week's episode and was very interested in our ACL coverage ratio discussion. Frederick C. was interested in our losses over time and gave us some kudos for evaluating the market every week. Our friend Oz was interested in some of our data, and it's always great to hear from Oz. Michelle F. told our colleague Callie that he is a faithful listener to our Friday morning TreppWire podcast and said that we are market leaders in CRE thought and credibility. So thank you, Michelle. Joel R. was interested in our Market Pulse webinar. We have a recording of that if anyone is interested. Rob B. was interested in our loss data and gave us some kudos. Derek F. was interested in some of our analyses. Munir I. thanked us for the podcast and the great data that we put out. Connor K. thanked us for putting out an awesome show week after week. He said his background historically was on the residential side within structured products, but recently he picked up CMBS and the podcast has been exceptionally helpful in getting him up to speed. So thank you for that. We have a lot of educational resources for clients, listeners, the market at large. So if you're interested, send us some notes. We have a lot of one-on-one blogs. We have a lot of podcasts, 269, 270. I don't remember what episode this will be, but a lot that you can listen to and continue that education. David L. was interested in some of our SASB performance and CMBS data. David C. was interested in the Market Pulse webinar. Duffy W. thanked us for our content. Yona S. said his team at his firm are avid listeners to the podcast and frequently discuss it during team meetings. So thank you for that. Adam S. was interested in some of the slides from last week. Manisha D. thanked us for another wonderful podcast. William L. was interested in bank CRE exposure, and we had some large apartment complex data that I think we'll try to get to you, William. And I think those were all the emails, but we did have a lot of other people tweeted us and post on LinkedIn. So thank you if you got in touch last week.
Yes, I had a couple this week too, Haley. Conrad M. had me on his podcast, the C-Suite podcast. I don't know when the episode will be released, but really great time recording with Conrad. Great to see what he's doing there in the Dallas market. John W. had tagged me in a post where it discussed some of the MBA delinquency data. It's really great. He's a podcast listener. He tagged us and referenced our green shoots segment. So it's good to see people using our nomenclature out in the wild. Thanks for listening, John. And interestingly, I had a couple of people reach out for the slides last week that we talked about with Stephen on the defaults. One gentleman wasn't able to find my Trepp contact info, so he actually emailed me at my Texas Tech email address. So Brian D., we will be getting you those slides. It took me a couple days to get the email, and because we're not quite in this semester yet, but I'll get those out to you. And Adrian C., I owe her the slides as well as some dates for the podcast. And so we'll be having some additional guests on. So really great week for us, and we appreciate the interaction. Keep them coming.
And another one is to our good friend, Bob Knackle. We saw that he released his first episode of the Bob Knackle Show. That was all over LinkedIn and Twitter this week, and we're very excited for him. We know that he has some great commentary, and it's nice that he has a forum to now talk about that with his audience. So we had him on the podcast a few months back. We did a lot of work with him and our friend Don Tepman, Strip Mall guy, for the Real Estate X Gala. So it's been great partnering with them, and we wish him the best of luck with his show. And I think we might need to have a TreppWire Podcast Bob Knackle Show collaboration in the next few weeks or months. So we'll make that happen.
Yeah, we're going to make that happen. And it's been cool watching Bob's transition away from the larger firm back to his own shop. They just moved offices from the Knackle Map Room into a bigger space. And the team he's assembled, brokers, These guys are going to be powerhouse players in the New York City marketplace. So if you haven't checked out their latest venture and the team they built, you should really check it out. The way they're leveraging technology and bringing some A-list players together, really going to set them apart in the market. So really cool to see happen in real time.
And I have some atypical shout outs that I just wanted to throw out for this episode because this news just broke today and it's a huge deal. Evan Gershkovich of the Wall Street Journal was released from his wrongful imprisonment in Russia. So it is so fantastic to have Evan back, along with former U.S. Marine Paul Whelan. Thank you for your service. Journalist Alsu Kermasheva and Vladimir Karamirez. So this is absolutely fantastic news. We are so happy to have all of you back and out of the Russian prisons because the stories that you read about the people that are wrongfully imprisoned there, it is absolutely heartbreaking. So absolutely fantastic news to have all of you back.
I was going to say, on top of that, it's been a pretty interesting and incredible week with the Olympics going on. It's always a great time to see the world come together and compete at the highest level. I don't know if you guys have had a chance to watch any of the events, but it's been a pretty cool thing seeing how, these people in the U.S. in particular that we root for have trained their entire lives and realized their dreams in a very quick moment. And so it's been a pretty cool week for me, just kind of keeping up with that on the periphery.
There is one event that caught my eye today, and it is the LeBron James of ping pong, a France ping pong player, Felix Lebrun, who is absolutely mind-blowingly fast. So I don't know if you've had a chance to watch any of these videos, Lonnie, but it is staggering, absolutely mind-blowing how quick this guy is. And he plays with a pinhold grip instead of a handshake grip. And the main weakness for a pinhold grip is a weak backhand. This guy moves so fast, he gets the ball right off the bounce.
Just watching those guys, it just makes me realize how little I've accomplished in my life, honestly, and how inferior I am, both in skill, desire, work ethic, etc. Those ping pong folks are incredible. Sand volleyball, same thing. I mean, we have the two women volleyball players, I think that were at LSU. Then the one is 5'4" or 5'5", little. And she's up there at the net, skying up over the net. I mean, her vertical is incredible. It's amazing watching these people. And the swimmers, obviously. I know we're going to get in the track and field later on. But yeah, to your point, those table tennis or ping pong, the fencing, same thing. It's I don't even understand fencing, but just seeing how quick they move, incredible.
And with that, we'll close. Join us next week as we look at what's happened during the week and how it may be impacting you. If you have a question or just a comment, send an email to podcast@trepp.com and subscribe to the TreppWire Podcast with your favorite provider. Thank you for listening and stay well.
All right.